Hello everybody, welcome back to the channel. I have an amazing video for you guys today. I found an article that you guys are going to absolutely love. Check it out. It's coming from marketwatch.com and I will have a link to this article down in the description below. Now guys, let me start. Housing affordability plunges to the lowest level since 2006. The property market's great slowdown is here. Bank of America says this is big news. A new report from Bank of America Institute adds that two more gloomy data points illustrate that the housing sector is on a downturn. Okay, so this is a big deal, guys. If you are in the market to buy a house or sell a house, you're really gonna want to pay attention to this because it is stern. We are shifting from a seller's market to a buyer's market, and what that means exactly is that in the last 2 years, sellers, had complete control of the situation. I mean, they were asking for, 10, 20, 30, 40, 50,000, 100,000 over asking price. They were waiving all types of contingencies. It was crazy. They were basically picking the shots. I mean, I heard of situations where people would sell a house and then ask the new buyers that they had to rent it back to them for like 2-3 months, and sometimes for free, right? Like they literally they had no stops, right? And now I think that those days are over because now it's becoming a buyer's market. What does that mean exactly? A buyer's market means that the buyer is going to have more, they're going to have more options. They're going to be able to pick what they want better. So what that really means is, the houses that look like crap, they're gonna sit on that market for 2, 3, 4, 5, 6 months because the only houses that are probably gonna sell are the ones that are the most attractive, right? And as prices come down, we're definitely gonna have a lot more, to choose from. And remember, the longer houses sit on the market, well, guess what happens? The prices keep coming down. So, you gotta think like, when those houses have been sitting on the market for 4 or 5 months, if you start offering lowball offers and someone takes it, well, that brings down the whole price of the whole community, right? So it's kind of like this weird thing where, with the supply being tight and there being, being a buyer's market, we're gonna see the nicest houses selling, but the lower, cheaper houses are gonna keep dropping, and that's gonna bring down the entire market with it. So that's kind of what I am foreseeing. But here, let's keep reading. Residential mortgage originations fell 29% on the second quarter compared to last year's, down to 14.5 billion, according to the internal data from Bank of America. That's because borrowing costs are much higher now compared to a year ago. That's in part because of the Fed's rate hike. I always have trouble saying that. Anyways, they're basically reaching the highest level since 2008. So it's here we go. Look at this little graph right here. As mortgage rates surge, housing affordability has plunged to the lowest level since 2006. So here is a huge problem. Housing affordability has plunged to the lowest since 2006. So if we look at red, housing affordability index, what does this mean? Okay, guys, what it means is that higher interest rates on the top of soaring home prices makes homes even more expensive for buyers. In the chart below, Bank of America's highlighted how housing affordability has plunged to the lowest level since 2006. With the pace of home sales slowing, consumers are pulling back purchases on home-related items. It is worth noting that nearly a quarter of the first-time home buyers open to new credit card within 6 months are buying a home. Based on that internal data, Bank of America report found that spending per household at furniture and home improvement store on Bank of America's card has been dropping. Spending has fallen on a year-over-year basis across the country since March 2022. Furniture and home improvement spending fell significantly, especially in the West and Northwest, and reported added by 7.4% to 8.1% respectively. That's a huge drop. So, you know what? Housing affordability rate index is going up. That is not right. That is not good. that is going to that is signs of a slowing economy, guys. You know, everything is pointing towards, you know, we are heading into an extreme buyer's market where we're going to have, you know, more supply. Right now, the new listing, look, the supply is tight right now. And the supply is tight right now because people are holding on to their properties, because people are scared. But like I've said in other videos, what's happening is people are beginning to be priced out of the economy, and like things are becoming too expensive. And if there's any shift, and if we start seeing layoffs, right, as a result of everything that's happening, this is going to be the catalyst that is really going to bring down the housing market. Because right now, if you look at the median sale price, 2019, okay, is blue and 2022 is black. Look how much the disparity is. It is way too much. In 2019, a house was $278. Now the same house is $387. Our salaries have not gone up this much. The problem was that it was able to go up in price to those levels because of the record low interest rates and because of the pandemic, and made people not necessarily want to put their house on the market. So there was a supply issue mixed with incredibly low interest rates, and it made the prices just soar. But it's not real, right? It's not real. It's not based on real economics of like a healthy economy. That's why, in my opinion, we are going to see a big crash. Now, a lot of people are saying it's not going to be like like it's not going to be like one day to the next. It's going to be like over time. It's going to like, some people think these are the new prices. I totally disagree. But they're not seeing a big crash. And I don't necessarily, I'm not saying that it's going to be like overnight crash, because remember, people essentially have to put their houses on the market, right? It's not like oil crashes overnight, right? It's not like Bitcoin crashing overnight. It's not like that. Like, in order for prices to crash in real estate, it takes a long time, because what happens is you put your house on the market, it sits and it sits and it sits month after month after month. Now, if you really want to sell that house and it's been sitting there, you know, for a month without any offers, then you know something. You got to lower the price. So then you lower the price. And if it sits for another month, right, you're going to say, okay, lower the price. But you see how this is happening over months? Now, let's just say you leave it for 6 months and you finally, somebody comes in with a very low ball offer and you say, you know what, fine, you sell it. Well, you just, because of that sale, you just helped bring down the average home price, right? But guess what? It took 6 months. It took 6 months of you waiting to get a high price and you know, waiting all the way till you sold it. So that's what, in a way, is what we're looking at, right? It is not going to happen overnight. Not in this type of economy. We need to see, in order for the house prices to really, you know, go down, inflation we need to see more foreclosures. We need to see possibly layoffs. We need to possibly see, you know, the stock market dropping. Now, guys, if you like these videos, don't forget to smash that subscribe button and go ahead and like and leave a comment. I want to just say a big thank you to everyone who has been watching my videos and, you know, commenting on my videos and giving me a thumbs up. Thank you guys so much for supporting, and I'm having a lot of fun. I just started and I've been getting a lot of views, and I really, really appreciate it. Thanks, everybody, and till next time, see you on the next video. I love you guys, and I'll see you soon. Thanks.